Hello friends and welcome to my YouTube channel Simply Stocks, and today I'm going to talk about Himachal Futuristic Limited, an interesting company that did very well from 2017 and 18 and also doubled from the lows of March this year. But what needs to be done now? So let's get started. First of all, a disclaimer that this is not a stock recommendation, and people taking any position to any share that I talk about should do that with their own due diligence and research. And I'm not in favor or against any company that I talk about. Before I talk about Himachal Futuristic, a small request that kindly support me on Patreon, and once you do that, it will help me grow the channel. It will also help you ask me questions on a daily basis. Once you get the $10 membership, you will have access to my portfolio, my watch list, and a number of podcasts that I put up from day to day. Apart from that, the watch list has a number of 70 stocks in which I give buying and selling prices and the ranges where you can get into the stock and get out of the stock. For detailed market or company talk, you can directly email me and we can work things out. Now about the company. HFCL, established in 1987, provide telephonic equipment. They are also into broadband hardware solutions. Products include optical fiber cables, power electronics, and optical transport products. Builds complete telecommunication network. So overall, looking prima facie, it looks like that the company is pretty good and is engaged in doing a very interesting work, because IT and especially internet is the big thing right now, and the expansion of internet is getting stronger with the two players really getting deeper into the market. If you look at the numbers, then the market cap of the company is around 2200, 2300 crores. This is the Q1 numbers. So the sales were up 6%, but the profit was down at 20%. Debt has increased largely over time, and pledging has increased, and pledging is huge. So from 60%, the pledging has gone up to 68%. Did well in this quarter, even though there was shutdown and there was a lot of problems in many places. So why it has gone out of favor? The first and biggest reason is that OEMs, or original manufacturers or original suppliers of internet, that is Bharti and Reliance, have their own cable networks, and especially Reliance have their own, so they don't you can say depend on any outsourcing of those cables and networking and etc., and do it themselves. There's heavy competition from other brands. There are multiple brands, listed brands, unlisted brands, that are there and that are doing much better than HFCL. Plus, there are Chinese brands which have been Taiwanese brands which have been doing well. Brands from Korea that have done well and have penetrated into Indian market. So things are getting difficult in this business. The margins in this business is not that strong. It's a very low margin business, and the biggest reason for the stock to be out of favor and to be trading at 16-17 rupees has been the high debt and pledging that the company currently has. There is competition from Asian countries, as I have just mentioned, and that just continues. And raw material cost is always fluctuating and normally on a higher side rather than on a lower base. So my call in this stock is probably sell on every rise. I have not even given you an idea of the you can say technicals, because the stock has been battered blue and black up at 17 and a half rupees. Any rise towards 19, 18 and a half, 19, just exit the stock. Let the numbers turn around. Let it feels like they are gaining market share and doing well in this business. And especially companies with high amount of pledging or debt need to be avoided. With 15-20% or less than that, pledging is fine, but here the pledging is around 68%. There's high amount of debt and the numbers are not that great to write home about. So you need to consider all these points before even looking at such companies. The whole sector remains under stress. So the telecom sector is doing well, but the telecom ancillary sector is not doing that greatly. You need to understand. In that respect, it is advisable to probably avoid ancillary and probably buy the telecom majors, probably both or at least one of them for the next 5 to 6 years, that would be a prudent strategy rather than looking to be cute with trades and getting into, you can say, telecom ancillary. Look for cash generating businesses, that would be even better. So if you look at businesses which are into consumer domain, not the large consumers, but even in the mid and small cap consumer domain, mid and small cap diagnostics, anything that is even indirectly related to consumers would continue to do well, and put only 5% of your total investment in such stocks. So this was my video on HFCL. Please like and subscribe my channel and hit the bell icon so that you get my videos straight away when I post it. Thanks a lot for watching.